Active Brokers. Deep discount direct access. 90+ markets worldwide.
Before we get back to the calls and emails, we want to remind you, if you want to make sure you never miss the top picks on Market Call, we'll send them straight to your inbox. Each night, BNN will send out those top picks and analysis from our roster of experts on the show and on Market Call tonight. You go to bnn.ca/subscribe to sign up for that nightly newsletter. And you'll also get Marty Say's unique commentary on the market-moving stories every morning. Yep, it's always a treat. Well, here's an email from Frida, the subject Morgan Stanley. Can I get your opinion, please?
Sure. So for those that have watched before, I've been on for a while now, and really since after the first rally coming off the bottom in 2009, we have consistently been very cautious and negative about financials. Financials overall, specifically investment banks, and the basic premise was that between the years 1990 and 2007, financials went from being a very small piece of the market to a very large piece of the index on the back of everything going right. Leverage expanding, fees expanding, capital markets doing well, all of those things. And as a result, they traded at multiples of growth stocks. And despite the fact they had a big bounce off the bottom after they all closed and went bankrupt, the fact is all of the major parts of these businesses are challenged. Trading volumes have never come back. You look at capital markets activities, financings, they've been weaker. The leverage is having to come down. Capital requirements are going up. Regulation is going up. And as a result, there's been a compression in the multiple the market's willing to pay. And I think that it's very telling that, that these things just cannot get turned around. We're in a weaker market. It's hard to have the market get better when financials are behaving as poorly as they are. And when you look at, some of the concerns around sovereign debt, I know that it's an overseas issue at this point, but these big companies are all interlinked, and the concerns around credit continue to hang around. And the cost of insuring against credit default is going up. I think it's just an area you want to avoid, and I think that it's a sector that's going to see multiple compression for quite some time.
Kate is on the line from Toronto. Go ahead, Kate.
The call, David. Great to see you on the program, and thanks for taking the call. My question is on energy as such, and Crescent Point in particular. From what I'm hearing, energy could go down quite a bit from here. And what then, in your view, would Crescent Point go down to?
Okay.
Thank you.
So there's really a two-part question here. First of all, our thoughts on energy. And I would say, yes, in the short run, there is some risk. I think it's interesting, oil prices backed off through that waterfall decline a couple of weeks ago. We got a rally that equaled about a half of what it had given up, which is about what you could have expected on a bounce, and it appears to have reversed back down again. So I think you need to be a little bit cautious with energy. If you are going to be in energy, and I can see a longer-term case for it, you want to be in an energy company that's paying you a cash flow yield. And so there's quite a number in Canada, fortunately. We are not in any of the majors that don't pay a significant dividend. We have owned Crescent Point over time. It had been a significant favorite of ours. We recently have come out of it. And frankly, it's not because of lack of growth opportunity, but they're financing a lot of their work that they're doing, we think, through paying out units in lieu of dividends in the dividend reinvestment program. And they may not actually be recapturing their cost of capital on that. So it does have a yield, and there's others. I'd prefer to own a Baytex or a Bonavista, but the net of it is the yield-paying energy companies are going to do better than the non-yield-paying. But there is probably overall risk in energy right now, and you want to be just a little bit careful.
We have Pushpa on the line from Toronto. Go ahead, Pushpa.
Andy, thank you for taking my
call.
Sure. David, do you think Magna is a good buy at the present price, or do you think it could go further with the market down? And also, which do you think has more of an upside within, say, within 6 months, Magna or Tech? Which one would you buy? Thank you very much.
Thanks. So, Pushpa, I'm going to go out on a limb a little bit here. We've been going through a recovery in the economy. We're a couple of years in. This period is starting to look a little bit like the 70s to us market-wise, where you had shorter recoveries followed up with cyclical declines in the market. We've had a very good 2-year recovery in equities. The economic figures are stalling out a little bit. Whether it winds up being a soft landing or a recession, it's possible that we could get a weaker period for the market. At some point over the next 3 to 4 months, we could wind up in a tougher period. So in general, we've been reducing our exposure to economically sensitive companies. Unfortunately, both Magna and Teck are economically sensitive. So I think you want to be a little bit careful. I think if you felt that the economy was going to continue to be strong, and this is just a short, soft patch driven by, say, the slowdown in Japan, then, you know, great company. But I think that in the short run, the auto parts companies and the metals companies and the equipment companies are probably not the place to focus. We think there is a rotation going on across various groups of investors towards yield, to less economically sensitive, more stable cash flow driven businesses. So I just don't think it's timely in the short run.
Coming up, we're going to get to David Burrows' top picks right after this.
If you want to